Can I buy a new home before I sell my current home? That is a fantastic question. We get it all the time. The short answer is possibly, or maybe better said, it depends. But assuming that you qualify, right, then yes, you absolutely can buy a new home before you sell your current home. All right, so that being said, there are specific goals that you should consider and appropriate steps to make it happen smoothly. So stick with me as we break that down for you. My name is Gavin Sessions with Loans Made Simple. If you are curious to learn about all things related to mortgage and home loans, subscribe to our channel. We post new content each week. If you're ready to get qualified for a home loan or you're looking to get connected to a great real estate agent, our contact information is in the description below. So I mentioned specific goals that you're going to want to consider, so we're going to jump into those first. So the first goal we want to mention is avoiding financial stress. So super clearly here, we are not talking about emotional stress, right? Now, buying a house is certainly probably one of the top 5 stressors in your life that you'll ever experience. But again, we're not talking about emotional stress here, but rather, are you able to afford this decision? Are you able to afford buying before you sell? And if you are, more importantly, do you want to afford this decision once you understand what those numbers look like? All right, so goal number 2 is something that almost everybody wants, which is a seamless transition. So often this question is being asked because you're worried about where you're gonna live in the interim if your current home sells faster than you're able to buy a new home. So the goal is obviously to avoid being stuck without a place to live. And this is where getting to work early with a trusted lender like us and an experienced realtor can help make this process as smooth as possible. All right, so the third goal that we think that you should consider is you want to maximize your equity, right? So your goal is obviously to maximize the proceeds that you can get when you sell your current home, whether that's prior to buying your next home or after. So this is where an experienced real estate agent and possibly an aggressive pricing strategy can have an impact on how quickly your home sells and your ability to maximize those proceeds. So one encouragement here, and I'm just looking right at you. So being too married to a specific price point, and I know a lot of sellers think their home is worth X. If you're too married and too stuck on that specific price point, it can have a negative impact on your ability to sell that home and could actually end up costing you more equity down the road. So one quick reminder here, we mentioned home equity, so let's quickly define that. It's basically the portion of the home that you own, and it's easily calculated by subtracting the amount that you owe on your current mortgage from the home's estimated current value. So quick example, if you think your home is worth $400,000 and your mortgage balance is $300,000, your home equity position currently is about $100,000. All right, enough with the goals. Let's jump into the meat and potatoes and outline these specific steps to make this work for you. All right, so step number 1 is to determine your buying power. And this first step is basically figuring out how much that you can afford while still owning your current home. Debt to income ratio is a financial metric, and it's easily calculated if we take the sum or the total of your minimum payments on your credit report that recur every month, and we divide it by your gross monthly income. So that's going to give us a percentage, right? And what we're looking for typically is a debt to income ratio of about 45 to 50%, depending on the loan program. The things that are going to show up on your credit report that will be part of your debt to income ratio are things that you'll be very familiar with, right? It's going to be a mortgage payment. It's going to be an auto loan. It's going to be student loans that you may or may not still have, plus those minimum payments on your credit cards, right? So all those added together, divided by your gross monthly income, is going to get us that debt to income ratio. And it's super important that if you're looking to buy a new home before you sell your current home, that we have to add the mortgage payment plus the taxes, the insurance, the HOA dues, the potential mortgage insurance, all those things into the debt to income ratio. And we still have to be at a ceiling of 45 to 50%, again, depending on the loan program that we're pursuing. All right, so let's wrap up this debt to income ratio with just kind of a simple way to think about it. The lower your debt to income ratio, the less risk on your loan and the more likely that you will be approved to purchase that new home before you sell your existing home. And the opposite's also true, right? So the higher your debt to income ratio, the greater the risk of your loan and the less likely that you're gonna be able to buy that new home before you sell. And honestly, the higher the debt to income ratio means your cash flow will probably be tighter, which might make it very uncomfortable for you to try to buy that home before you sell. So really an important thing to evaluate and think about. All right, so now we discussed debt to income ratio. Let's quickly review your assets that you have available to help with the down payment and the closing costs to purchase that new home. So if you've got sufficient assets to make a down payment and cover your closing costs, then moving forward might be the right option for you. But you should note that you might end up with a larger loan amount than you really wanted. And of course, a larger loan amount is going to mean a larger monthly payment. So certainly need to be aware of that. So as an alternative, most folks probably have their assets tied up in their existing home as equity, and you might find yourself needing that equity in order to make a down payment to purchase a new home. So if that's the case, it's unlikely that you'd be able to buy before you sell, but we're not dead in the water, right? There are some options for you, specifically if maybe you've fallen in love with a home already, which is very dangerous, and I do not recommend that. or maybe you have got some other urgency for whatever reason, right? So there are some options for you. The first would be a bridge loan. You've probably heard of a bridge loan. A bridge loan is a really cool product, and it can help provide you access to the equity in your current home without having to sell that property. So one thing to note, these products are meant to solve a short-term problem, and therefore they can be very, very expensive. So I always want folks to go into a bridge loan eyes wide open and fully understand what they're getting themselves into. So we should clarify one thing though. You're probably asking this question because you're looking to either upsize, downsize, right size, left size, relocate, who knows, but you're likely looking to buy a new primary residence. So that's the important thing I want to note. If you're here and you're actually looking to purchase an investment property or a second home, this video probably is not the specific answer for you. I think stick with us. There's going to be some good stuff in it, but worst case scenario, reach out to us, scroll down, find our contact information, leave us a comment or fill out our form, and we'd love to connect with you. All right, so a couple highlights on a bridge loan. In simplest terms, it's basically a cash out refi on your departing residence that gives you access to your equity that you can then use as a down payment to purchase that new home. So it's a short-term loan. Usually it's a 12-month loan is it, right? And it's basically interest only for that time period, right? So it's often a brand new cash out refi. Like I said, it's going to be interest only, meaning you can make a minimum interest only payment if you like, but often no monthly payment is required. So once your home is sold, you do have to pay that bridge loan back in lump sum, right? So as I've mentioned, bridge loans are going to be more expensive because they're meant to solve an urgent problem that is usually short term, right? So you're going to pay for that typically with just higher loan costs as well as a higher interest rate. Now, one of the really cool things about bridge loans is you're often able to avoid making that minimum monthly payment. So interest only, you don't have to make the payment. And if you choose not to, your balance will grow over time, right? So a specific example is maybe you take out a bridge loan and you owe $100,000 on your house. By the end of maybe a 10-month time period, if it took you 10 months to sell the house, it's possible that your loan balance will have grown to around $120,000, right? So just really simple high-level math, and that would depend, of course, on the specific bridge loan terms that you agree to. So just keep that in mind. Let's conclude bridge loans here, and you can probably tell that I don't love this product, honestly, but they can be great for the right borrower or the right situation. So we're happy to help answer your questions. We're happy to help with a bridge loan if it ends up being the right option for you. All right, so if you need to get access to the equity in your existing home without selling it, another great way to do that is with a HELOC, right? So a HELOC stands for Home Equity Line of Credit. Basically, it is a credit card that's secured to your home, right? So if you go get a credit card today from a bank, that is called unsecured debt, right? And you're going to pay for that through a substantially higher interest rate, right? If you get a HELOC, you're getting a credit card, which is a revolving line of credit effectively, but it's secured against your home. In other words, your home is collateral. And because the home is collateral, you're going to be rewarded with a substantially lower interest rate. So a HELOC is a really cost-effective way to get access to your equity. And it's certainly something that we would recommend and we can absolutely help you with as well. So a couple of things to note about HELOCs. Again, interest only, similar to a bridge, which is cool. Typically, when you take out that line of credit, you're going to have up to 10 years to use that HELOC before you're required to pay back a principal and interest payment. And it's going to be usually amortized out over the next 20 years. So we would never encourage you to make interest only payments for 10 years because then that balance is still there after 10 years. So in a conversation with us, we're going to absolutely encourage that you make some principal payments towards that HELOC. But in the event that you don't, the balance will still be there, and then you're going to be required to make a principal and interest 20-year amortization payment. So quick pro tip on a HELOC, if you're planning to sell your house, we strongly recommend that you go get that HELOC in place before you list your home. And the specifics for that is it's a much lower risk loan when you take out a HELOC against a primary residence versus a home that you're planning to sell. So if you got further questions on that, leave us a comment, fill out our form. We'd be happy to have a conversation with you. All right, so let's move on to step 2-ish. And I say ish because it's really probably not part of the process, but it's likely something that you're thinking about, right? And that's a contingency. So what is a contingency or what does making a contingent offer mean? Well, it effectively means that you're planning to sell your house before you buy. And a contingent offer actually gives you protections as a buyer that lets you out of the contract to purchase that home in the event that you're unable to get your home sold by a certain date. And that would give you a refund on your earnest money. So often in competitive situations, if you love a house or you really like a house and you want to make an offer on it, or maybe there's others that are interested at the same time, the seller may not accept a contingent offer. In other words, you're going to have to make a non-contingent offer. And that puts us right back to the question at hand, which is, hey, can I buy this house that I might love or want before I sell my existing home? So let's make this practical for you. So what if you found a home that you love, or maybe you found a home that other people love as well, right? It's a competitive situation where your offer is not the only one that's being submitted. Often in that situation, you're going to need to make a non-contingent offer, which really truly puts us right back to the question at hand, right? Which is, can I buy this house before I sell my existing house? And by definition, then you're being asked to make a non-contingent offer. So if you've got questions about contingencies, leave us a question or comment below. Fill out our form. We'd love to connect with you about your specific situation or question. All right, on to step 3, and it's certainly a key step in the process, which is getting pre-approved. So it's absolutely essential. And a pre-approval is going to tell you exactly how much that you can borrow. And it shows the seller of the property that you've gone through your due diligence and that you're serious about being able to buy that house, right? So pre-approval, if you're unaware of what that process is, it's basically a thorough review of your income, your assets, and your credit. And what we're looking to do is determine your ability to repay that loan, right? And that's done through a loan application, it's done with a credit report, and it's done with a really thorough review of your income and your asset documentation. So our ultimate goal with getting pre-approved is that you would avoid going shopping for a home and falling in love with a property that you either can't afford or that you may choose not to afford because of what that monthly payment looks like, right? And then worst case, you're out looking at a property that you love and you find out you actually can't make a non-contingent offer. In other words, you're not in the situation where you can buy before you sell. So hopefully you now have a great understanding of what it takes to buy a new home before selling your existing home, and if that's something you want to possibly tackle. If you're watching this video, you're likely in the market to purchase a new home, and if you're ready to buy or refinance, click the link in the description below to reach out to us. Next, we suggest you check out this video. It'll help you continue your education of the home buying process.